Okay, this time we are looking at the international framework for liquidity, risk measurement, standard and monitoring. So the Basel Committee on Banking Supervision has instituted broad reform with respect to both capital and liquidity requirement. The committee has instituted two new liquidity requirements. They have indicated that the requirements are met to be minimum standard and the banks may choose to maintain higher of the liquidity. The liquidity coverage ratio is defined as the stock of high liquidity assets to the total net cash flows over the next 30 days of the calendar. Banks must maintain a ratio of 100% or greater, and this standard is meant to improve the short-term resilience of the bank in terms of stress. The net stable funding ratio focuses on long-term liquidity and is intended to protect bank over a one-year horizon. It is defined as the available amount of stable funding relative to required amount of stable funding and must be greater than 100%. In addition to these two new standards, committee has instituted new global liquidity monitoring tool. Let's look at the background of this thing. The liquidity has been the ultimate risk, and during the financial crisis in 2007, things were exacerbated because of liquidity crunch. Liquidity evaporated quickly and illiquidity lasts for extended period of time during the turmoil. So the committee insists that all banks as well as regulatory authorities must fully participate in order to reform to work. The committee also insists that the new requirements are minimum standard and that bank and supervision may implement more stringent requirement on individual bank depending on the bank's specific liquidity risk. In addition, bank must adhere to sound practices as set forth in 2008 paper, Principles for Sound Liquidity Risk Management Supervision. The stated objective of liquidity standards are complementary. The two objects are as follows: to ensure that banks have adequate liquidity to survive significant stress scenario for 30 days. The next is to provide incentive for banks to develop more stable funding sources so that they can withstand liquidity shock that last over long-term horizon. Let's look at the first ratio. It's called the liquidity coverage ratio. The liquidity coverage ratio is used to ensure that banks have adequate high quality liquid asset to survive a short term of stress. The definition is stock of high quality liquid asset upon total net cash flow over the next 30 years is greater than 100. The LCR is a traditional coverage ratio. It requires that the banks have enough quality liquid asset to fully cover total net cash flow over the next month. The goal is to have enough liquid asset that can be covered to cash either by sale or by secured borrowing to provide a safeguard against a period of severe liquidity stress. The liquidity of these assets must remain intact even in a period of bank specific or overall market stress. Both high quality liquid asset and total net cash flow outflows are defined in greater details in this document. So an asset is liquid if can be converted easily and immediately into cash with little or no value of loss. So during the crisis, financial institutions were attempting to liquidate asset in a fire sale environment. High quality liquid asset must be unencumbered, that is not pledged implicit or explicit to secure, collateralize or provide credit instrument for any transaction. The assets are meant to act as a source of potential liquidity and must be managed as such. Now, high quality liquid asset. Fundamental characteristic of high quality liquid assets include high credit standing of issuer and low market risk, credit valuation, low correlation with risky asset, and listed on recognized exchange. And market related characteristic of high liquid assets include active and sizable market, committed market makers, diverse buyer and seller, and flight to quality. Now, ideally liquid assets should be the central banks eligible. So there are two categories: level 1 asset which can be included without limit, level 2 asset which could comprise of only 40% of the high quality stock. So level 1 asset is cash, central bank reserve, marketable securities, and marketable securities were assigned 0% risk weighting, traded in large, deep and active market with low concentration. These securities must be proven reliable source of liquidity even in a time of stress. They may not be the obligation of financial institution. And non-0% risk-weighted sovereign or credit bank securities. Now, level 2 includes stock of liquid asset comprising of no more than 40% of overall stock after haircuts have been applied. A minimum 15% haircut is applied to current value of each level 2 asset. marketable securities assigned a 20% of risk weighting under BASEL. The securities must be traded in large, deep, active markets with low concentration. These securities must be proven reliable source of liquidity even in the time of stress. They not be obliged at a financial institution. Securities must have at least double rating if they are rated by external credit enhancement. If not rated, the probability of default must correspond to a credit rating of at least AA. The net cash outflows. Now they are defined as outflows over the next 30 days calendar, and outflows is equal to outstanding balance of various type of liabilities and off balance sheet commitment into rates at which they are expected to run. Inflows is equal to outstanding balance of various categories of contractual receivable into rates at which they are expected to flow in. Bank may not be able to double count items. If an item is included in numerator of a liquidity coverage ratio, it cannot be again counted as an inflow. There is a cap on total inflow as well. The committee does not want bank to rely solely on expected inflows to cover outflows. They want bank to maintain a stock of high quality liquid assets. Thus, the amount of inflows the bank can assume will offset the outflows is capped by 75% of expected total outflows. The effective cap is required to maintain a minimum liquidity asset ratio of 25% of expected outflows. So since the timing of bank inflows and outflows is uncertain, banks as well as bank supervisor must be aware of liquidity mismatches that may occur in a 1 month period. Bank specific or market wide shocks may result in drain on bank's liquidity. In general, banks may experience an individual combination of following: retail deposit runoff, losses of unsecured wholesale funding, loss of secured short-term funding, outflows that result from a downgrade of bank's public rating, risks that impact of quality of collateral or future exposure to area position, require large collateral haircuts or need for additional collateral, unscheduled or unexpected draw on line of credit, and the need to buy back debt or honor non-credit order to protect bank's reputation. Now, cash outflows could include retail deposit turnoff and unsecured wholesale funding runoff and derivative payables, liquidity that results from downgrade triggering embedded in derivative contracts. So those are the outflows. Now, net stable funding ratio is something that we are going to look at. So while the goal of liquidity coverage ratio is to make market more resilient to liquidity shocks in the short run, the goal of net stable funding ratio is to protect banks over long-term horizon. A sustainable maturity structure of asset and liability is important for long-term viability. The net stable funding ratio promotes a sustainable maturity structure for assets and liabilities by creating incentive for bank to use more stable funding. The committee expects bank to do a better job of watching the maturity of liabilities to assets rather than relying on very short-term wholesale funding. So that is defined as available amount of stable funding divided by required amount of stable funding. So that's the net stable funding ratio, and this should be greater than 100%. Stable funding sources by definition must be reliable over 1 year time horizon under condition of extended stress. The amount of stable funding required vary from institution depending on liquidity characteristics of bank asset and option balance exposure. Any illiquid asset and security should be backed by stable funding ratio according to this methodology. In addition, there should be stable funding to support calls on liquidity arising from off-balance sheet commitment. Now we have something called the available stable funding sources, which is called ASF. Now the ASF are capital, preferred stock with a maturity greater than 1 year, liability with an effective maturity of greater than 1 year, non-maturing deposit, and the proportion of wholesale fund that would be expected to join the bank in the extended stress. The goal is for the bank to have an ongoing source of funding in a stressed period. Stress in this case would include customer becoming aware of significant decline in bank profitability, solvency, downgrade, deposit or counterparty credit rating, or material event that cause bank to reevaluate bank's reputation or credit quality. The committee does not want bank to rely heavily on central bank funding in time of liquidity stress. It does not want to include extended borrowing from central bank, lending facility and calculation of stable funding sources. Assets and liabilities are assigned to one of the 5 available sources of funding category. To calculate the total funding available for purpose of calculation, the amount of each category is multiplied by ASF, that is available stable funding ratio factor, and then summed up. Figure there are some figures that indicates that funding sources have a specific factor that's assigned to each category, which are based on some logic which are made by the committee. The amount of stable funding resources is a weight of sum of all this funding thing. So stable and funding sources and their associate ASF, required funding and their associate ASF. So there are stable funding and there are required funding. So if you remember the formula, available amount of stable funding and required amount of stable funding. So you have a funding and you have some obligations. So stable funding sources are like tier 1 plus tier 2 capital plus preferred stock, then stable non-maturity amount of term deposit, less stable non-maturity upon unsecured wholesale funding. And requirement funding are cash available to meet obligation, unencumbered marketable securities, unencumbered corporate bonds. Now we move to the last part here, which is liquidity monitoring tools. So there are contractual maturity mismatch, concentration of funding, available unencumbered asset, liquidity coverage ratio by significant currency, market relating monitoring tool. The first is contractual maturity mismatch. Banks and supervisor need to more consistently monitor liquidity at both the bank and system-wide levels. The committee has instituted various metrics that will assist information gathering and assessment of banks' liquidity. In addition, there might be country jurisdiction specific liquidity issue which must be monitored by supervisor in a specific jurisdiction. Gaps between the contractual inflows and outflows of liquidity are known as maturity mismatches. The contractual maturity mismatch identifies the amount of liquidity a bank may need to raise in specific time. Now, definition of a contractual maturity mismatch. Contractual and security inflows and outflows form all on and off balance sheet items mapped to defined time banks based on respective maturities. The time banks are 7 days, 4 days, 1, 2, 3, 4, 9 months, 1, 2, 3, 4, 5 years. Practical application of this metric include the following. So those are: data collected must be reported to supervisor. The model is based off contractual flow and no behavioral assumption. Bank should be able to apply behavioral assumption of inflow and outflow and should consider both normal and stress condition. Bank must identify how they plan to address liquidity gaps generated by maturity mismatch. So that was contractual maturity mismatch. Then we have concentration of funding, available unencumbered asset. So concentration of funding. In concentration of funding, banks rely on wholesale funding. As evident by recent financial crisis, removal of that funding can sometimes deliver a fatal blow to the bank. The concentration of funding metric attempts to identify those significant sources of wholesale funding which, if withdrawn, could trigger liquidity problems for a bank. In keeping with sound principles, the metric encourages a diverse mix of funding scenario. So definition of concentration of funding ratio is funding liability source from each counterparty divided by bank's total sheet. So then we have available and unencumbered asset. Data regarding the quality, key characteristic and currency denomination, location of bank under asset provided by available of unencumbered asset metric. These assets are potential source of liquidity and in that they can be used as a collateral for other secured funding or other eligible at central bank. Definition and available of unencumbered asset: assets that are marketable as collateral in secondary bank and eligible for central bank standing facilities. Bank must report the amount, type and location of these assets. The assets should be categorized by significant currency. In addition, bank must eliminate haircut the secondary would require of each asset. Practical application of metric include that this data should be combined with maturity mismatch and the data does not capture counterparty haircut, lending policy and could change either into a system-wide or an idiosyncratic event. Then we have the liquidity coverage ratios by significant currency and market related monitoring tools. So definition of liquidity coverage ratio by significant currency is foreign currency liquidity coverage ratio, which is stock of high quality liquid asset is in significant currency upon total net co 30 rate in insignificant currency. In the market related monitoring rule, we have market wide information based on financial sector and bank specific information. So that was all on the liquidity risk. In the next part, we are going to look at revision to BASEL 2 market risk framework, which is capital for specific and general charge, and where we'll look at BASEL 2 market risk framework, and we'll expand the discussion of accounting for securitization under BASEL 2, which was introduced previously. And for the exam, we have to look at stress tests and understand risk factor considering when pricing securities such as liquid securities and commodities. So in the next part, we are going to look at the stressed VAR formula and market capital requirement for the stressed VAR. So I think that would be it for here. Thank you for listening to this video. I hope it added something to your current knowledge base.